Hey everyone, welcome to another video. In this one, I want to go over the tobacco industry in detail, focusing on the three biggest players, Altria, Philip Morris, and British American Tobacco. We'll look at the business prospects of these tobacco giants and see if it's worth investing in them for 2022 and beyond. Let us begin by taking a look at the broader tobacco industry. It is widely known that cigarette smoking rates have fallen significantly in developed markets like the United States, Europe, and Australasia. Looking at America more specifically, we can see the staggering pace of this trend away from smoking. 42% of the adult population smoked in the 60s, down to 25% in the 90s, and all the way down to 12% today. Although this is amazing news from a public health perspective, it paints a pretty dire picture for companies that rely on cigarette volumes for the majority of their sales. From a global perspective, we can see that over the past 30 years, almost all the countries with big populations have experienced a decrease in the percentage of people smoking cigarettes regularly. North America, Europe, China, India, South America with Brazil leading the charge, and most of Africa as well have all seen 25 to 50% falls in smoking prevalence. However, if we look at the picture from a different angle, it's possible to see that it's not all doom and gloom for cigarette companies. Due to the massive population growth that has been occurring in the past 3 decades, the actual number of global smokers has increased from about 1 billion in 1990 to 1.2 billion today. And of course, most of that growth has come from fast-growing populations in China, South America, the Middle East, and the majority of Africa. This leaves global players like Philip Morris and British American Tobacco better positioned to weather the transition away from smoking than a company like Altria, where 100% of their sales come from a single developed country. If we look at revenues by geography, we can see that in 2020, British American Tobacco made 44% of their total sales in the United States, 23% from Europe and North America, 18% from Asia Pacific and Middle East, and 15% from Americas and Sub-Saharan Africa. And Philip Morris is even more diversified. In 2020, 37% of their revenues came from the European Union, 12% came from Eastern Europe, 10% came from Middle East and Africa, 15% came from South and Southeast Asia, 19% came from East Asia and Australia, and 6% came from Latin America and Canada. Overall, both British American Tobacco and Philip Morris seem well insulated from the trend away from cigarettes, given that the rate of decline will probably vary from country to country. But even then, the outlook for big tobacco remains alarming. After all, Altria obtains 100% of its sales from the USA, British American Tobacco makes roughly 60% of their sales from the United States plus Europe and Canada, and Philip Morris makes 37% of their sales from the European Union. These are all very mature markets with low population growth and some of the fastest rates of decline in cigarette consumption in the world. Yet, these three businesses have managed to keep revenues increasing or at least flat in the past 20 years. From 2016 to 2020, Altria grew their revenues from $19.3 billion to $20.8 billion, which is a 1.5% compound annual growth rate. British American Tobacco went from $14 billion to $25 billion for a 12% compound annual growth rate. And Philip Morris went from $26 billion to $28 billion for a 1.5% compound annual growth rate as well. Keep in mind, most of British American Tobacco's growth came through acquisitions, but we'll talk about that in more detail later. The point is, these CAGRs are not impressive, but they are far better than what would be expected in an industry shrinking by 2% every single year. The key to these results is demand inelasticity for cigarettes. Demand for a product is considered inelastic if a change in the price does not significantly impact demand for that product. Thanks to strong brands and mostly thanks to the addictive properties of nicotine, big tobacco companies are able to consistently hike the price per pack of cigarettes without affecting demand from consumers. Compare that to a branded cereal, for example. If the price of a branded cereal shot up 20% tomorrow, then most likely demand for the product would go down since people would find an alternative product whose price had not skyrocketed. All this to say, demand inelasticity for cigarettes is probably the greatest weapon used by tobacco companies to combat declines in cigarette consumption. And this weapon is particularly efficient in developed markets like Europe and North America due to the high purchasing power of populations in those countries. Let's use the United States as an example. The US is currently one of the fastest eroding markets for cigarettes, declining at a rate of around 4% per year. However, it is still one of the most attractive markets in the world thanks to the low price to pay for a pack of ciggies. A pack of Marlboro only costs $8 per pack compared to almost 12 in France and 16 in the UK. What this means if you are a tobacco company is that you have ample room to raise prices for many years to come in order to offset the declining volumes of cigarettes consumed. So even though Altria and British American Tobacco collect 100% and 45% of their respective revenues from a market in decline, their current numbers are not likely to decrease anytime in the near future. Another factor to consider is the price segmentation of cigarettes. Overall, it can be said that cigarettes come in one of three price segments: premium, mid-tier, and low price. As you could probably guess, the premium segment includes all of the brands that you've likely heard of even if you've never smoked a cigarette in your life. For example, you've got Lucky Strike, Marlboro, or Camel. These higher priced products are crucial for the profitability of big tobacco companies. In 2011, a report by Citigroup stated that the tobacco industry is profitable only because smokers are willing to pay a significant premium for some brands. I am 99.9% sure that that statement is still true today. Not surprisingly, brand loyalty tends to be the highest for premium brands, and previous academic research has shown that premium price segments are associated with a statistically significant level of lower smoking cessation rates. All this means is that people who smoke from big brands tend to quit smoking less. So the mix of price segments in a cigarette manufacturer's portfolio of brands is at least as important as the volume of cigarettes sold. Manufacturers with a higher percentage of premium brands will undoubtedly post higher margins and returns on invested capital than manufacturers focused on the lower price segments. Imperial Brands is one of those manufacturers that focuses mostly on low price segments. According to Morningstar, Imperial derives 25% of its sales from premium price segments versus more than 50% from discount segments. If we look at their operating margin, we can see that it usually hovers between 8 and 10%. They also consistently manage to get a slightly above average return on invested capital of around 9% and a return on assets of 4%. Remember that return on invested capital is how much cash a company gets back for each dollar invested in the business. For example, the making of cigarettes. And return on assets measures how much net income a company generates for each dollar of assets on the balance sheet. In the case of our cigarette companies, this would be the amount of cigarettes they have in stock. Let's compare Imperial's numbers to those of the three companies we are interested in, starting with Philip Morris. Philip Morris's portfolio of brands skews very heavily towards the premium price segment. According to the company's own reports, they are actually the company with the most percentage of sales coming from this segment, 55% of their volumes to be exact. Their leading premium brands include the world-famous Marlboro and another one called Parliament. In theory, this should lead to a better business than Imperial's, and if we look at the numbers, we can see that this is in fact the case. Philip Morris's operating margin hovers around 40%, which is 4 times higher than Imperial's. That means that for every $100 in sales, Philip Morris keeps $40 in profits versus only 10 for Imperial. That's a massive difference. Not only that, but the average return on assets over the past 5 years is around 18%, and the return on invested capital fluctuates between 32 and 50%, although that's not really shown over here. Altria, which is basically Philip Morris in the US, has an even higher operating margin of 50%, return on assets of 15%, and an average return on invested capital between 20 and 30%. This number has fallen from the sky in recent years due to all the significant write-offs they've had from bad acquisitions, but we'll talk about that in more detail later. British American Tobacco actually has the most balanced cigarette portfolio of all manufacturers. 1/4 comes from the premium category, 1/3 from the mid-tier, and the remainder comes from the low price category. Their premium brands include Lucky Strike, Newport, and Kent. British American Tobacco has an average operating margin of 35%. Similar to Altria, BTI completed the acquisition of Reynolds in 2018, and this drastically reduced their return on assets and return on invested capital because of the price they paid, but before that, they consistently averaged 14% and 23% respectively. So clearly, Philip Morris and Altria are more efficient businesses thanks to their strong premium brands, but British American Tobacco is still a good business that manages to post above average results year in and year out. Now I want to move on to one of the most important aspects of a business, the moat. Remember that a moat is what allows a company to generate above average returns for long periods of time by preventing competitors from stealing market share. Tobacco companies actually benefit from a massive moat that has led to some of the best returns in history. From 1968 to 2015, Altria was America's most successful stock, posting returns of 20% per year during that time. That leaves the S&P in the dust. And in the UK, when the FTSE index turned 35 in 2019, can you guess which stock was the best historical performer since the inception of the index? That's right, British American Tobacco. And that's even after the company saw its stock halved from 2017 to 2019. And keep in mind, these companies were able to achieve this while operating in an industry that has been in decline since the 60s. Only their strong moat made that possible. The moat for tobacco companies manifests itself in two main parts: intangible assets and cost advantage. Altria, Philip Morris, and British American Tobacco all benefit from two intangible assets. The first is probably the most obvious, and that is the addictive property of nicotine. Consumers are literally addicted to the products sold by these companies. I hate to say this, but that is one of the stickiest moats out there. According to statistics from the Tobacco Atlas, more than 60% of all smokers attempt to quit, and 42% have attempted to quit over the past 12 months. And clearly, the decline in smoking rate isn't near that high, which means that people who do attempt to quit are probably not successful. This leads me straight to the next intangible asset, which is insurmountable barriers to entry. Imagine the concept of cigarettes was introduced in 2021. I think we can all agree that the product would never hit the shelves due to safety and moral issues. Health agencies such as the FDA in America would not deem cigarettes to be safe for the general public. And even if they did become available as a luxury product, there would be strict regulations in place, extremely high taxes, etc., which would make it a non-viable business. Well, this is exactly the experience of companies that attempt to enter the tobacco industry today. Regulatory agencies have made it nearly impossible for new entrants to take market share from the established tobacco players. In the United States, the FDA has made it so that tobacco products introduced after 2011 require manufacturers to prove that the new product is, quote, substantially equivalent to existing products. If that can be done, the product has to go through a long approval process organized by the FDA. This is basically a mini patent like the ones you see in the pharmaceutical industry, only this one lasts forever. As a result of this rule, companies are less pressured to invest in fast-moving pipelines. As if that wasn't enough, most high-income nations impose marketing bans on tobacco companies. Now, this is the nail in the coffin for potential new entrants who might have received a green light from regulatory agencies. How do you grow a customer base if you aren't allowed to market your product? Not only does this rule affect new entrants, it also has a positive effect on existing players. In the consumer goods industry, a high percentage of profits is usually invested in marketing budgets to maintain the brand image and fend off competitors, but not big tobacco. For example, in 2020, Altria spent 6% of operating cash flows on marketing. Philip Morris spent 8%. In comparison, Procter & Gamble, who owns dozens of leading brands of staple products, spent 19% of operating cash flows on marketing. Kimberly-Clark spent 37%, and Kellogg spent half of their operating cash flows on marketing. This is a significant disadvantage and makes tobacco companies more efficient businesses in that regard. No marketing means no worries about new entrants, lots of money saved, but it also means steady market share for existing players and limiting price competition. That's because lack of advertising discourages smokers from switching between brands. So to recap, intangible assets for tobacco companies include the addictive nature of nicotine and government regulations that essentially allow them to exist as monopolies. Now let's move on to the cost advantage part of the moat. Cigarette manufacturing is a scalable business that benefits from economies of scale. The higher the volume of cigarettes you sell, the more you can spread the cost of overhead charges. As a result, there is an inverse relationship between volume of cigarettes sold and the cost per pack. To put it more simply, the bigger the company, the higher the profit margin. Philip Morris is the biggest benefactor from economies of scale. With 704 billion sticks sold in 2020, their operating cost per pack of cigarettes was 47 cents. British American Tobacco comes in next with an operating cost of 57 cents per pack on a volume of 658 billion ciggies. Altria comes in well last out of these three with an operating cost of 78 cents per pack on a volume of 99 billion sticks. But since premium brands make up 90% of their volume, their operating margin holds up to the other two. Cost advantages constitute the third and last part of Big Tobacco's wide moat, although this applies more to Philip Morris and British American Tobacco since they operate on a global platform. Now, with all that being said, the tobacco industry is currently undergoing one of the biggest disruptions since the 1960s, when the image of cigarettes got completely destroyed. As the industry experiences more and more regulatory pressure in the highly lucrative, highly inelastic developed markets, companies have been forced to rethink their business models to shift away from traditional combustible tobacco products like cigarettes. After all, smoking rates have been declining year after year, and that can only be offset with higher prices for so long. As a way to look forward to the future, Big Tobacco has started to invest more and more into next generation products, or NGPs for short. And although they are marketed as new or next gen, companies have usually been developing and marketing versions of these products for decades. You probably have heard of them in the past. They include e-cigarettes, also called vapes, heated tobacco, snus, oral tobacco, and even therapeutic products like lozenges and patches. So basically, anything that's not a traditional cigarette. What's interesting is that all tobacco companies are taking different routes and using different strategies to make the transition into NGPs. This is something that's extremely important to consider before you invest in any of these businesses. Having the right strategy and being able to execute it will be key in determining whether they succeed in the long term or not. Let's start by looking into Philip Morris. Up to date, it's got to be said that they have set the bar and been the leader of the NGP revolution. When they launched the Unsmoke campaign in 2019, management made it official that they intended to move away from cigarettes and focus on non-combustibles. They aimed for 50% revenues to be coming from NGPs by 2025. Leading the charge is their flagship product, the IQOS heat stick. Basically, this is a battery-operated device that heats up a tobacco stick, which comes available in different flavors. In some countries, Philip Morris is able to sell IQOS under the Marlboro or Parliament brands. Other than that, Philip Morris dabbles in some other next-gen products like snus and vapes, but these segments are not nearly as big as IQOS. From their third quarter earnings presentation, we can see that IQOS user growth is strong, although last quarter was a bit disappointing. So far this year, 28.6% of net revenues have come from NGPs. Management's target is to get to 40% by 2023 and 50% by 2025, but these are very optimistic goals and only time will tell if they will be able to deliver. Nevertheless, the growth is there and Philip Morris is one of the best positioned big tobacco companies when it comes to the NGP revolution. It's also important to consider the financial metrics of NGPs like IQOS. As it turns out, the economics of heat sticks are actually very favorable for manufacturers like Philip Morris. First off, net revenue per pack is 2.4 times a pack of cigarettes, and gross margin is 10% more, coming in at around 75%. Selling and overhead expenses are probably higher than cigarettes at current volumes, but that could change with scale. As we discussed before, the higher the volumes, the higher the margins. IQOS heat sticks are also taxed at lower rates than cigarettes currently, but that could change in the future. But investing in Philip Morris comes with a few risks as well. Like with other big tobacco companies, litigation risks are a constant threat, although the company's strong cash flows would allow them to deal with lawsuits with relative ease. I would say the bigger risks to Philip Morris would be government regulation. For example, the implementation of plain packages measures for the bigger markets would lead to less brand power, and consumers would most likely trade down from premium to lower price segments. As a result, margins would decrease as well as returns on invested capital and returns on assets, which would mean a less efficient business. That's a risk for all of big tobacco. It's also important to consider that although NGPs are the future of the tobacco industry, it's not yet clear how profitable these products will be at scale. But at the end of the day, I do think Philip Morris is a great business to own. They are definitely the best placed company to weather the transition away from cigarettes. They are very well diversified geographically, and the cherry on top of the cake is that management's track record has proven that they know how to make the right investments. If we quickly look at the financials for this company, we can see that revenues have been growing ever so slightly in the past 5 years. But if we zoom back to the last 10 years, revenues have basically gone nowhere. So this is a very stable but very slow growing business, which means that any gains we will get from investing in this will come from share buybacks, dividends, and from buying at an undervalued price. Shares outstanding have remained even for the past 7 years-ish. We can see from their balance sheet that they have around $37 billion in long-term debt. The number has not increased dramatically over the past 5 years, so that's good to see. If we consider their 5-year average free cash flow of around $8 billion, it means they would be able to pay that down in 4 to 5 years. Not only that, but they also have $21 billion of current assets, so overall I would say the balance sheet looks really good. Free cash flow has been increasing slightly over the past 5 years, from $6.91 billion in 2016 to $10.5 billion in the past 12 months. They pay a hefty dividend of around 5.7%, which is equal to $7.51 billion per year. Given that average free cash flow over the past 5 years was $8.3 billion, the payout ratio is about 90%, which usually would be worrisome. But it is characteristic of tobacco companies to have high payout ratios, so this doesn't worry me very much. So considering the slow growth, but also the strong business model, the wide moat, and the stability of the business, I think a multiple of 15 is warranted for Philip Morris. 8.34 billion of 5-year average free cash flow times 15 equals $125 billion. $125 billion of market cap would lead to a fair value of around $80 per share. Next, let's move on to Philip Morris's sister company, Altria. Altria used to be a part of Philip Morris until 2008, when the company decided to split their operations in the USA and the rest of the world. Although they are now two separate companies, Altria still has exclusive rights to market products and technologies that are developed by Philip Morris in the United States. So everything I said earlier about Philip Morris and their NGPs applies to Altria. They are slowly rolling out IQOS in large metropolitan areas, but recently have come up to somewhat of a hurdle when the US International Trade Commission ruled that IQOS violates a patent held by British American Tobacco. As a result, Altria won't be able to import or sell IQOS in the country. Of course, this spooked investors away, but the reality is that at worst, those hurdles will set Altria back a few quarters while they find ways to circumvent the patent infringement. Altria is also taking a slightly different strategy than most big tobacco companies. Instead of just diversifying into NGPs, they are also diversifying into whole other businesses. 15% of their revenue is based on a 10% stake they have in Anheuser-Busch InBev, which is an alcoholic beverage business, and another 15% comes from oral tobacco and wine. They also own 35% of a vape brand called Juul and 45% of a Canadian cannabis company called Cronos. For now, these holdings contribute very little to overall revenues, but they will likely grow in the future. Personally, I really like the fact that Altria is looking to diversify into other industries, especially ones like cannabis that are very young and still have lots and lots of room to grow. However, it is a much riskier strategy since usually the price paid to acquire new businesses is higher than the value received. And that's exactly what happened with Juul. Altria paid $12.8 billion for a 35% stake in Juul, which at the time was a promising company that was growing a lot and threatening Altria's dominance in the US market. However, as soon as the transaction was completed, Juul was hit with a ton of lawsuits and Altria wrote down their investment to $1.6 billion. That's an 88% loss in less than 2 years. That's definitely one of the worst investments I've ever heard of. But you could give management the benefit of the doubt and view the acquisition as insurance for a doomsday scenario where Juul would have become a really big player in the US and taken lots of market share away from Altria. Catastrophe control, so to speak. In my opinion, Altria is definitely a riskier investment than Philip Morris. They have been slower than their sister company at deploying IQOS and NGPs. So far, 85% of revenue still come from cigarettes. Also, Altria doesn't benefit from economies of scale like Philip Morris and their competitor British American Tobacco since they only operate on a national level. This also extends to NGPs. Altria can only hope to have similar economies of scale for IQOS and cigarettes if they ended up combining with Philip Morris down the line, which they actually have tried doing recently. That attempt failed, but they will very likely try again in the future. Geographical concentration is another risk with Altria, even if the USA is one of the most attractive markets in the world for tobacco companies. The FDA is a real menace for Altria in America. A menthol ban has been in the talks for the past couple of months. This would really negatively affect Altria's business since a lot of their products contain this flavor. And if this popular flavor was banned, who knows if smokers would be more likely to give up on their habit or if they would switch to another flavor. Recently, the FDA also talked about imposing a restriction on nicotine levels in cigarettes, which would obviously reduce their addictive potential. So far this is just talk, but if it ended up happening in the future, there could be two possible consequences. Either people would buy more cigarettes to satisfy their cravings, or the smoking rate would plummet very quickly. Whatever ends up happening, government regulation is a constant risk due to the uncertainty of the business outlook. When we look at Altria's revenues, we can see that just like Philip Morris, it is a very slow growing business. However, sales do grow consistently year after year very predictably. This is probably a consequence of operating in the US market where yearly price increases are predictable and reliable. They have also been really good at buying back shares year after year. I love that about Altria. They have 7.1 billion in current assets versus 35 billion in long-term debt. That number is quite high. The positive is that their average 5-year free cash flow is so high that it would allow them to pay down the long-term debt in about 5 years. But that's borderline safe in my opinion. What's more worrisome is that the debt was used to pay for big acquisitions that ended up being complete failures. Nevertheless, free cash flow is increasing pretty rapidly. Over the past 5 years, the average free cash flow was $6.9 billion. They pay $6.39 billion in dividends, which is equal to a 93% payout ratio. This is really high, but again, typical of tobacco companies. Nothing to be worried about. I think Altria deserves a multiple of 12, mainly due to their wide moat and predictable business. If it wasn't for that, I would assign a 10 because it is a slow growing business with an elevated risk profile. 12 times 6.9 in free cash flow is $82 billion. That's the equivalent of a $44 share price. I think Altria is currently trading slightly below fair value. Finally, we move on to British American Tobacco. Similarly to Philip Morris, British American Tobacco is a truly global business. The geographical diversification means BAT is less likely to be harmed by regulations in any single market, but it also means that the company benefits from a wide moat thanks to economies of scale. When it comes to NGPs, BAT has the most hedged position across emerging categories when compared to other big tobacco companies. They have 3 main brands of NGPs. Velo is their main snooze and pouch brand. Glow is their heat stick brand. This is the rival to IQOS. And finally, they've got Vuse, which is essentially a vape. All of these brands are growing extremely fast at a rate of 50% when comparing the first half of 2021 to the full year of 2020. Velo and Vuse are leaders in market share for modern oral and e-cigarettes respectively. However, BAT is still lagging rivals Philip Morris by quite a bit in terms of total NGP market share, especially in the heat stick category. They have targeted $5 billion in total sales from new categories by 2025, but revenue is not a great measurement since categories like vaping have lower margins and lower barriers to entry than cigarettes, while heat sticks and snus have higher margins. In 2017, British American Tobacco completed the acquisition of Reynolds, which gave them lots of exposure in the US. This market has experienced less decline in classic cigarette sales due to the strong Newport brand of menthol cigarettes. Even so, BAT's risk profile was elevated in a major way after the acquisition because of the price of the transaction that resulted in lots of debt on the balance sheet and because of the threat of a menthol ban in the US, which is not likely to ease in the short term. Looking at British American Tobacco's revenues over the past 10 years, we can see that they were pretty steady until 2017, then they had a big jump after making the Reynolds acquisition. And since 2019, revenues have been in slow decline. That's not a super good sign. It means we'll probably assign the company a lower multiple during the valuation process. Shares have held steady since 2017, which I'd like to see. If we look at the balance sheet, we can see they hold $59 billion in long-term debt, which again is a really big number. Along with selling shares, this is how they financed the Reynolds acquisition. Clearly, there was a huge increase during that year. They also hold $13.6 billion in total current assets. Free cash flow since 2017 hovers around $8.5 billion, so it would take them close to 7 years to pay down all their debt. That worries me a little bit, but we can see that the debt is actually going down little by little, so they have been focused on paying that down. They pay a huge dividend of 8.7%, which is equal to $6.75 billion. That amount is very easily covered by the cash flows. In fact, British American Tobacco has a payout ratio of 79%, which is considerably lower than Philip Morris and Altria. In terms of free cash flow multiples, I assign BAT a 10 because despite having stagnant revenues and lots of debt, I do still think that it's an efficient business with a wide moat, and that management will be able to generate high returns on assets and invested capital for years to come. So if we multiply 10 times 8.5, we get $85 billion, which is the equivalent of $36 per share on the ADR version of the stock. So just to recap, I think Philip Morris is the better and safer business to own out of the three companies we talked about today. This is why I assigned them a multiple of 15 versus 12 for Altria and 10 for British American Tobacco. Even so, I do think that the other two are still high quality businesses that I would like to own for the right price. But at the end of the day, these investments come with some pretty significant risks, and I would only invest in big tobacco companies if I thought that NGPs will be able to match the moat and profitability of traditional cigarettes in the mid-distant future. I would also keep an eye out for extreme regulatory changes that might precipitate the downfall of smoking rates. Currently, I am invested in Altria, and I also own a tiny bit of British American Tobacco, and I would likely add to both of these positions if they started trading at or below fair value. Anyways, let me know in the comment section if you disagree with the multiples I assigned, or if I missed some important information about one of the companies that were discussed in this video. That's all for today. I'll catch you next time. Peace!